Hey everybody, Brian Shannon here from alphatrends.net. Today's Sunday, it's the 27th of December 2015. Hope everyone enjoyed their extra time off, and we've got another holiday shortened week ahead, just 4 days. So let's take a look at this market. We bounced back basically from the precipice here. The S&P 500 was up close to 3%. Oil led the way with close to a 6% gain, still obviously in a horrific downtrend there, down 44% year to date. And the S&P 500 just slightly positive year to date, but keep in mind that doesn't include any dividends paid, so it's actually a little bit better than that, whereas the Russell 2000 has been the underperformer. So let's take a look, and just a reminder, or maybe I hadn't mentioned it, but on Wednesday I will be doing a free webinar about looking at some of the losers from 2015 and lessons learned. I think this is going to be a great webinar. I'm excited about doing it. There's some really good lessons. We have a bigger picture, on the weekly S&P 500. We've got a lot of uncertainty here, and this year we've basically been up and down, above and below that positive year to date. I don't know, half dozen times or so. I haven't counted, but it makes stock picking and recognizing the trends of the individual stocks that much more important. And there's going to be some great lessons there. It will be recorded, but it will only be available to people who register for the webinar. I'm not going to post it on Alpha Trends. I'm not going to post it on YouTube. So if you want to participate live, it will be Wednesday at 5 p.m. Eastern Time. If you want to view it at your own pace, that's fine, but you've got to register to attend, no exceptions. Let's take a look at this market. We've got this big mess going into, 4 days left in the year. We've got the market that has been really recently just kind of hanging in this box basically, and we had seen that it looked like it was really hanging on the precipice there. As I always mention, we don't want to be the person who sells short down here, not after a drop of that magnitude, dropping 4% from 208 to 200. You don't want to short after a 4% decline in 2 days. Now, what we have here is we have a low volume rally back up to this prior little band of support in here, and this has been an important level really throughout the year. This band of support and resistance that is formed in here. So we've got the 50-day moving average overhead, which is still advancing, but the pattern is when we look at a 30-minute time frame, it's just a big giant mess. And realistically, you can look at it and say that these lows, are high, or these highs rather, are lower than the prior highs, and that the support is being tested more frequently. I think that the worst scenario would be for us to come back down towards this level, bounce again, but not quite as high. And then I think that heading into 2016, at least the beginning of the year could be in for a rough start. But bigger picture still is a lot of indecision here, of course. So it remains a market that is best suited for trading, not for investing. This week, let's see if this plays a factor. This is, just been a little bit of a recent downtrend line that comes in at about 207. We did have some selling late in the day on the half day there on Thursday, was it, I guess? And that sets the market going into next week as let's see if we can pull back down and hold the 5-day moving average. I think this is going to be a key level next week, is about that 203-ish level. If we can hang above 203, then perhaps we bounce from there, rebuild some energy for a break of that 207. But again, back to the daily time frame, we've just got this bigger, more neutral looking picture. So it remains murky, and that's why at Alpha Trends we remain focused on individual stock ideas and look to make quick intraday trades in the ETFs. The Nasdaq, for its part, still another market that's kind of been in this box here over the last 2 months. We're back to really what is the midpoint of this range that we've had, and that's where we have that 50-day moving average. So it's hard to get excited either way when you're in the middle of a range. The point is that we have rallied on diminished volume here the last few days. Now, only price pays, but it's good to be aware that the volume is diminished on this, and that leaves it vulnerable. It doesn't mean it can't turn higher from here, but it leaves it vulnerable. We're at the conjunction of the 20, that's the blue, and the 50, which is the green, 20 and 50-day moving averages. And a lot of times that when we see these moving averages crossing back and forth as we have, it represents indecision, and that's what we have here. On the bigger picture in the Nasdaq, we could still go either way here. We're, on one hand, you could say we're holding up nicely, but if we break back down below this cluster of moving averages where we have the 20, 30, and 40 week or 100, 150, and 200-day moving averages, then heading into next year could be an issue. And the key band of support in here right now is really right around 109 to 110. And similar to what we were talking about in the S&P 500, the bearish scenario would be that we come back down, create a lower high again, and then what we would be seeing is that we would be seeing more frequent tests of support, which diminishes the demand there, and we would be seeing lower highs on these bounces, showing that the sellers are getting more aggressive price-wise and time-wise. Now, I'm not making that as a prediction. I'm saying here's what we need to be aware of. People who try to make predictions in the market are going to get caught on the wrong side of it, whereas if you're looking for the potential scenarios, it tells you where the low risk, high probability trades are and when to really shorten your time frames. As we're in this messy general picture, it's the time to shorten your time frames and not make those longer term bets. The Russell 2000, for its part, as we know, has been the weaker market this year, and we see that it's still stuck below the declining 20, 30, and 40 week moving average. That's not a bullish sign here. We're also below that 50-day moving average, and the 50-day moving average is heading lower slightly. So this is the potential bigger band of resistance right now, that if we can't get back above and hold above that, then I think that the sellers will be able to re-exert what's been their dominance this year in the Russell 2000. So we had seen that again, breaking trend lines, as we saw a couple months ago. A breaking of a trend line does not mean a reversal. It means the rate of descent, the rate of that trend has slowed down. We still have a bigger picture mess here. We have mixed messages on multiple time frames, which tells us we're either in a period of distribution that will lead to bigger declines, or the market's being accumulated and getting ready for another markup. When we have the indecision, we don't know what will happen. We don't predict, but we wait for the market to give us the evidence, and we look at shorter term time frames and say, well, if we can get beyond this level, that's a victory for the bulls. If we can get above and hold above 116, then that's an intermediate term victory for the bulls. If instead we get rejected from here again, that weakens the resolve of the buyers and puts the burden on the buyers there, meaning that more downside would be most likely, especially when we have the weekly chart looking as bad as it does. The semiconductors held a key area of support this week. They bounced from that. They did so on diminished volume. Only price pays, but we need to be aware. It doesn't mean we only look at price and that's the only thing. Price needs to be 90+% of a reason to buy or sell. You can't buy based on volume. You can't sell based on volume. I mean, you can, but to me, it doesn't make sense because only price does pay. And the 50-day moving average has the ability perhaps to trap this market right now. And if that occurs, then I would think that, this band of support, 52.5 to 53, if that, continues to be tested and weakened, that it's likely to break. And then we have the semiconductors as an important group, then below most of its key longer term moving averages, which puts us on larger defensive mode still. The biotechs, again, very similar to the Russell 2000. Breaking a trend line doesn't mean it's reversed. It means that rate of descent has slowed. And then what we're seeing now is over the last 2 months, we've been going in this this sideways range. Our upper edge of the band of resistance, we're coming right back into it after bouncing from the lower band of support. So most of the last week or so had been kind of focused around the midpoint of that range in there. And now as we come up towards the top end of that band of what's been resistance that has the potential to still be resistance, we have to say, okay, well, based on price action, we're above a rising 5-day moving average. We've just come from 315 to 340. So where have we come from? From 315 to 340. Where does it have the potential to go before it's likely to encounter a source of supply that will act as resistance? And that's right in this area. It's been resistance before. It doesn't mean it will continue to be, but after moving from the low end all the way up to the top end in a short period of time, the market has expended energy, and we have to be alert that here we could potentially break out. If we did break out, I think the better way to do it would be to kind of pull back once again and then even go sideways for a few days and then break out. That way we would have a nice higher low that if we want to buy such a breakout, we could put our stop underneath the most recent relevant higher low and then give it a shot. See if the buyers are in fact able to continue to hold up and exert their energy. But the fact is, when we pull back to the weekly chart, just up ahead, we've got that declining 30 and 40 week moving average. Those are what a lot of institutional investors consider as their line in the sand. If they're below those moving averages, they consider these markets guilty till proven innocent, and they're looking to lighten their long positions. Look for how many years we've been above these rising moving averages. We've had a few shakeouts below them, but we've been above those longer term moving averages. And now we were in the position of, is this just another period similar to late 2011 that we're building for a break higher? It's certainly possible, but let's let the market decide. Let the market give us the clues, and our job is to interpret them and to manage risk for the time frame that we're involved in. Shares of Apple remain a mess. They are looking like, unless they can get back above, I think it was maybe 110.38 or so was the close last year, then you're going to have a negative year for Apple. I suspect they're going to try to get Apple positive year to date. Who knows? I mean, it's really an irrelevant benchmark. What should matter most is the most recent trend and where you're positioned according to that. So that, of course, depends on your time frame. If you bought in 2013, you're seeing profits deteriorate, but it's a lot different than owning it at the average price that Apple has traded at this year. So the year-to-date volume weighted average price, in other words, for Apple is up here at about 120. So the average participant is down about 12 points, the average long participant who purchased it this year. So again, it comes down to time frame, but we've got this market below a declining 10, 20, 50, 100, 150, 200-day moving average, and that trend, once established, is more likely to continue than reverse. So we could get bounces in Apple, but I certainly would not trust this stock going forward. Don't forget that webinar is Wednesday. It will be recorded, but it will only be made available, the recording, for people who register.